My name is Shiloh Lundahl and I'm a real estate investor, and in today's video I'm going to explain how I built a portfolio of up to 250 properties over the course of maybe 5 years. And I'm also going to share with you how I'm able to offer interest rates to my private money lenders of 13 to 15% and still come out way ahead. At the beginning, I had a business partner, and that business partner and I built a portfolio of up to about 250 properties, including 80 single family homes, 100 units in mobile home parks, some commercial, and some multifamily properties. I don't share that with you in order to brag, but I share that with you because it's a difficult process. And if you understand the process, you can do it too. And let me tell you a little bit about the process. My business partner and I would find a property, and we would usually find a property that was marketed at well below what it should be worth. And it was marketed below what it should be worth because there either needed to be a lot of repairs that needed to happen on the property, or maybe something had happened to the owner and now their heirs own the property, and they just wanted to sell it because they were out of state. Whatever it was, we were able to come across these properties that were below the market value. And then we would take those properties, we would fix them up, and then we would either sell them like flipping a house, or we would rent them out on lease options where we would bring in a tenant buyer and they would live in the property for a few years until they got their credit where it needed to be and they saved enough for a down payment so that they could buy the property. So that was basically the investing model that we followed for several years. And it's easy for me to tell you that that's what we did, but you don't have the details, the how we did what we did. So let me give you some of the details because I think it's really helpful. So first, as I said, we would find these properties well under market value. And then we would go and we would buy these properties with hard money loans. And these hard money loans we were able to get through hard money lenders. Hard money lenders are people that either manage a fund or they have money themselves, and they're willing to lend to real estate investors so that these investors can go and buy the property in cash, which was often the situation that needed to happen because you couldn't get a loan on the property or they needed to sell it quickly. So we would get these hard money loans and we would be able to buy the property. But the hard money lender would not lend us all of the money to buy the property. The hard money lender would often lend us either 80% of the value of the property or would lend us maybe 90%. And then we had to come in with either 10 or 20% of our own money in order to buy the property. That's fine if you have tens of thousands of dollars or hundreds of thousands of dollars. The way that we started out is we had a home equity line of credit. And with that home equity line of credit, we were able to withdraw some money from that line, and we were able to put it with the money from the hard money lender in order to buy the property. Then we would take a little bit more money from the home equity line of credit and we would fix up the property. And then when we were done fixing up the property, we would go to a bank and we would say, hey, Mr. Banker, we have this property and the value should be about $200,000 according to comparable sales in the area, and we want you to refinance the property for us. So we would get that property refinanced and we would pay off the hard money lender. But often what would happen was this: the banker would say, okay, well, we'll give you whatever you purchased it for plus what you rehabbed it for. We'll give you 80% of that value or 70% of what it's worth, whichever is less. So when we would find a really good deal, we were still penalized because what would happen is, say we found a property that we were able to buy for $100,000, and maybe that property needed, $40,000 to bring it up to value. And then the value was actually $200,000. So we found a really great property. Well, what would happen is they would look at what we bought it for, 100. They would look at what we rehabbed it for, 40,000, and they would give us 80% of that number. So we would be able to get a loan for $112,000. And if the property was valued at $200,000, man, that just sucked because the loan that we were getting was less than 60% of the value. So that's how we started. We were getting these types of loans. We had to leave a lot of money into these deals, and it was just frustrating because it made it so that we couldn't grow very quickly. Well, one day I went to lunch with a guy that was a real estate investor, and I would regularly go to lunch with people in order to build my network and learn and things like that. And at this lunch meeting, I was talking to him about our situation, and he said, well, why don't you just get a second note on that property? I'm like, well, what do you mean? Yeah, you just have somebody give you a loan behind the bank. And so you would have the bank lend you 112,000, and then you'd have somebody else come in and you could leverage that property up to maybe 70 or 75 or even 80%. And so somebody else in second position would come in, they would lend you, $20 or $30,000, and then you could take that money and you wouldn't be out of pocket very much anymore. Now, you probably wouldn't cash flow very much because you'd be paying money on the first mortgage that you had with the bank, and then you'd be paying money on the second mortgage that you had. But at least you would have a property where you have a lot of built-in equity. So I thought about that and I thought, you know what? That is a fantastic idea. So that's kind of how we continued to grow. In 2016, in 2017, we bought a bunch of properties and we used this specific method. So we would buy them well under market value, we would get them fixed up, we would get a loan on them, and then we would go to people and we would talk to them about lending to us behind this first position note. And they would lend to us with a second position note and they'd get a deed of trust on the property. And so that was the way that we kind of built our portfolio to so many properties within a 5-year period of time. Now, finding people that were willing to lend to us behind the first position note was difficult at first because, a lot of people are like, hey, I don't want to be in second position. I only want to be in first position. So where do you find these private money lenders? Well, at the beginning, it was very difficult because I needed to convince people that I was somebody trustworthy enough for them to lend me money and they would get their money back plus the interest that I had promised. So we'd go to all of these meetups and I had all of my properties on this sheet of paper and I would show them, okay, I have this property, it's leveraged at this amount. I'm looking for somebody that would come in second position and I would give them a certain return on their money. And I was giving them like 10 or 11 or even 12% on their money. But it was very difficult to find anybody that was willing to trust me enough to lend me that money. But I knew if I stuck with it that I would find somebody eventually. And that's what happened. So I was going to all of these meetups, finally connect with one person, and I'm looking for just a $10,000 second on one of my properties. And as I'm talking with her, we have a great conversation, get to know each other, and then I let her know about the deal, and she looked at me and said, yeah, I could do that. And so she lent me $10,000 on one of my properties. But what was great is that gave me confidence knowing that it was possible. And so that same week, I had 2 other people reach out to me and also lend to me on some of my deals. So within a relatively short period of time, I was able to get all of the second position notes sold to investors. And at the time, I was giving between 10 and 12%, depending on the amount that they lent and the length of time. Then within a few years, the property values started to go way up and the rents went way up. And we were able to take a bunch of those properties and we were able to refinance them into a portfolio loan. So what that means is we went to a bank and the bank took all of those properties and they did appraisals on them. They noticed that, they were worth a lot and that we weren't leveraged very much. And we were able to pay off the other bank and we were able to pay off all of these second position notes. So it worked really, really well for us. And it also worked out really, really well for the people who lent us that money. So that's basically how we grew such a large portfolio. It was finding properties well under market value, it was getting loans, and then it was working with private money lenders in order to help pay out some of the equity that we had in order for us to continue to grow. So we weren't cash flowing a whole lot during this time, and it was okay because I had businesses, my partner had businesses, and those businesses were taking care of the majority of our living expenses. So in addition to being a real estate investor, I'm also a child and family therapist. I meet with kids, I meet with parents, I meet with couples, and I, help them with the things that are going on for them. And that was the business that was helping me pay for the majority of my living expenses. So because we didn't need a lot of the income from our real estate companies in order for us to live, we were able to continue to grow, put back all of the profits back into the company and continue to buy. And we were able to get these bank loans, and then we were able to get the private money lenders behind the bank loans. And so that's what we did, and we did that for several years, and it worked out really, really well. So now it's 2024 and things have changed quite a bit in the real estate market. I still find properties that are well under market value. I'm still able to find people that want to lend to me in second position in order to get a return on their money. And I still continue with this process. However, with interest rates the way that they are, it's been difficult to sell properties like I used to be able to. So some of these properties that I have that should be selling right now are sitting on the market, and they're sitting on the market for I don't know, 2 months, 3 months. And it's frustrating. It's frustrating because you have this good property, and this would be a property that normally would be sold pretty easily and pretty quickly. But because what I think, interest rates being so high, I think that it makes people feel a little bit nervous to buy properties right now because, well, one, they can't afford the property, they can't qualify for the property, and so it's difficult for them to even be able to buy it. But not only that, I think that the election has a lot of people nervous to see, what's going to happen in the market. So a lot of people are waiting until after the election in order to buy. And one more thing, I don't mean to be political, but there really is inflation and people are really feeling it. And so if they're having a hard time being able to buy groceries and get gas and different things like that, if their basic standard of living is just higher, not because they've actually improved their standard of living, just because the cost of their regular standard of living just costs more today than it did a few years back, then a lot of people don't feel like they're in a place where they can even afford to get a home. So I have those 3 strikes that are against me right now for selling the properties. And so my properties tend to sit longer. Well, right now, my wife and I have an opportunity to buy an assisted living facility in Mesa, Arizona. We've looked at the numbers. The numbers look really good. The people are going to stay on staff in order to help us through this transition of the purchase of the property and the business, which is great because that oftentimes is the thing that's difficult, is being able to transition new owners into something. And so they're going to stay on and they're going to help us through this whole transition. So we want to go ahead and buy this. But in order to buy this, we have to raise about $500,000. So right now our portfolio consists of about 50 single family homes. Then we have some commercial and some mobile home parks and things like that. And we're thinking, we can go ahead and sell some of these single family homes and we can raise $500,000 in order to have the down payment to buy the assisted living facility. However, right now is not a good time to sell properties. And so if I go to sell a property, let's say it's worth $300,000, and I go to sell it for $300,000, I think the buyer is going to come in and say, you know what? I'll give you $280,000 for that property. So not only would I probably get an offer for less than what the value is of the property right now, but then they would probably ask me to fix up things with the property, and I'd also have to pay for a realtor to help me sell the property. And so a $300,000 property, I could probably sell right now and get out of it probably $260,000. Wow, that would be a $40,000 cost just to sell this property. That would be awful. And I don't want to do that right now. What I'd like to do is I'd like to bring in more tenant buyers into these properties, people that want to own a home but are having a hard time being able to qualify for one right now, whether it's because the interest rates are high or because they need time for a down payment or they need to fix their credit or whatever. So what I want to do is I want to bring these people in to buy the home, and I wouldn't sell the home to them for $300,000 today, because in 3 years the home would probably be worth more like $320,000 or maybe $330,000. If you take the average appreciation of 3% per year, then it would probably be worth about $330,000 in the next 3 years. So rather than selling the property and getting $260,000 out of it, what I'd like to do is I'd like to bring somebody in. They live in the property, they work towards buying the property, and then they buy it from me within the next 24 to 36 months. And as they buy the property, they're going to be buying it at that higher price, that future price. And so as they buy it at that future price, and as their tenant buyers, I don't have to pay for a realtor to help me sell this property. They just come in, they live in the property, they know the property, and they're accepting the property, and they usually will do things in order to improve the property, which is fantastic. So that's the idea. I bring somebody in, they're able to buy it from me, and they buy it from me at that higher price. So because of this unique time in the market, I'm actually able to offer between a 13 and a 15% return on these second position notes now. And I'm able to still come ahead with even offering such a high interest rate on these second position notes. And let me explain why. Because you know how I said if I were to sell today, then what's happening is I have to take a discount, and selling with a realtor, I take, another 6% or so off the top. Well, if I wait just a few years, my theory is that the prices in the next 3 years are going to be a little bit higher than they are today, because I think the interest rates will come down a little bit, and as they come down a little bit, I think values are going to go up. So let's say that in 3 years, I do have this increase in valuation and the tenant buyers are exercising their options. So I sell a property at $330,000 rather than getting a $260,000 amount today. So let's take that $300,000 property as an example. Let's say that that property is only leveraged at 50% because the majority of my portfolio is leveraged about 50%. So it would have a loan on it for $150,000. So I can take that and I could leverage that property up to, let's say, 70% and still have 30% equity over and above that. And so if I were to leverage it to 70%, then I could bring somebody in behind that first mortgage. So they could come and lend me $60,000 above the $150,000 first mortgage. And the whole loans for those properties would be about $210,000. So if it was $210,000, the property is still worth $300,000. There's still $90,000 of equity in this property. So let's say that they were going to lend me $60,000. So if they lent me $60,000, then I could give them an interest rate of 14%. So between 25 and 50,000 is 13%, between 50 and 100,000 is 14%, and then 100,000 or more is 15%. So let's say they lend me 60,000, so they're getting 14%. So what is 14% of $60,000? Well, 15% would be 9,000. So it's just a little bit less than $9,000. And these notes that I'm doing are called interest deferred notes. So none of the interest would be paid out to them during the time of the note. But when I go to sell that property within the next 2 to 3 years, and that property value is higher, I have a tenant buyer in there that's going to be buying the property, then I'm able to pay them out their $9,000 or $18,000 or $27,000 at that period of time. Now remember, I'm able to get $330,000 rather than just $260,000 from the sale of that property. And I also get debt pay down during all of that time. So that more than covers the interest that I would need to pay them each year. So that's how I'm able to give such a high interest rate on a second position note and still come out ahead. And then with the money that I'm able to raise from these second position notes, I'm able to then go and buy this assisted living facility, which on paper, as we've been working out all of the numbers, should have about a 15% cap rate. And we should be able to make about $20,000 a month in cash flow from it. So this is my video for today. Hopefully it was helpful for you in understanding how I built my real estate portfolio, how you may also be able to leverage hard money and private money in order to build a real estate portfolio for you. I would say just be careful. You don't want to get over leveraged. And I know what that's felt like in the past. You want to be really mindful because it's important that you're always upfront with your private money lenders and that you always make sure that you pay them off. You never want to get in a situation where you owe more than what the property is worth. You never want to get into a situation where you're not meeting your debt obligations. So thanks for watching. If you have any questions, go ahead and reach out to me or leave a comment or a question in the notes below, and I'll do my very best to respond. So thanks for watching, and I hope that you have a fantastic day and good luck investing in real estate.